In this video, I want to discuss some share investing principles, some principles which will serve you well if you are interested in investing in shares. Shares over the long haul are very, very good investment, but you do need some basic guiding principles, some rules to help you make good decisions, good investments. That's what I'm going to look at in this video. I'm going to give you 6 principles or 6 rules, and these rules will serve you well. If you adhere to them, if you stick by them, then you will make money in the stock market, buying shares, holding shares in the medium to long term, and you will make money, a good return. But you do need to stick by the principles, and they are sound investment principles which I have not made up or arrived at by some fanciful notion of studying textbooks or any other method, but I have looked at the principles and teaching used by 2 gentlemen who are probably the most successful investors in the history of investing, Peter Lynch and Warren Buffett. And that's where these teachings come from, and I have applied them myself to my own portfolio in the last number of years and have done well as a consequence, and I've gained a fair degree of confidence as well in investing and in doing what I'm doing. First thing you need to be aware of and you need to be mindful of is that you are not looking to predict the future. You're not looking to predict the stock market. You're not looking to predict interest rates. None of the macroeconomic factors that might feed into an economy over a period of time are capable of prediction with any degree of certainty. So that's not what we're trying to do. So don't delude yourself by thinking that you can make predictions about the stock market and how it's going to perform over the medium term or short term. And it is not really the stock market that you're concerned about. It's individual companies, individual businesses, and individual shares. So the first thing is, don't worry about trying to predict anything. Don't worry about trying to forecast with any degree of precision how interest rates or the stock market or anything else is going to go. Secondly, the buying a share or buying a stock, but buying a share is not like buying a lottery ticket or buying a betting slip at the races if you go racing. It's not a gamble. What you are, or shouldn't be a gamble, what you are doing is you're buying a sliver or a piece of a company, and so your job is to identify the best companies for you to invest in. So you're looking at sound companies, you're looking at businesses that you will know and understand, and that's critical. That's the second principle, though, is that you are buying not a lottery ticket, but you're buying a share in a functioning company, a functioning business. The third thing you need to understand, and is a comfort, is the fact that as a small investor, you have a big advantage insofar as you can buy and sell whenever you choose to buy and sell. Unlike institutional investors who will be a lot of the time pumping shares or pumping stock or selling stock on behalf of their clients and on behalf of their either individual investor clients or companies for whom they are engaged to place shares for, to raise capital and so on. You don't have to worry about that. You can make an informed, objective judgment, rational, cold analysis of every company that you might be interested in having an interest in, that you might be interested in buying a share in. So you've got time on your side. In relation to getting the timing right, you don't actually have to get the timing right, because if you bought, for example, Microsoft when it floated, you would have made a fortune. But if you made the fatal, or what you might think is a fatal mistake of waiting 3 years, for example, you would have made 10 times your money. Likewise with Walmart. When Walmart floated it, you would have, if you bought the shares when it was first launched on the stock exchange, within a relatively short period of time, you 500 times your original investment. When in fact, if you held on for 10 years, imagine, you could have got your timing that delayed and that badly wrong, you would have still made 35 times your original investment. So time is on your side as a small investor, but you need to use it wisely. You need to use it in order to do a little bit of rudimentary, fundamental research about the company and about the shares that you're proposing to purchase in. But that is the third principle. Fourth, invest in companies who sell products or services that you know and understand. In other words, we all know what Ryanair does. We all know what Coca-Cola does. We all know what Total Produce do, for example. They do fruit and import bananas and so on and so forth. It used to be Fives. But it's important that you actually have a fundamental understanding of the business and what your company is engaged in, as opposed to taking a punt on a company that's making some very high-tech, risky, obscure, perhaps artificial intelligence related thing, or something of, with advanced technology that most normal people simply cannot understand. If you buy shares in a company that you understand, then you have the comfort of knowing what they're doing essentially, and you can from time to time check them out and even carry out the most basic research. For example, if you have shares in Dunkin' Donuts, you can go and visit, or Lidl or anywhere else for that matter, if they were on the stock exchange. You can go and visit the stores and carry out some basic research yourself, but you would know from what's going on in your area and in your country, for example, whether stores were closing down, whether they were opening up, whether they were expanding, whether they were losing market share, for example, in the retail market, and so on and so forth. But it's very, very useful to actually invest in companies who are engaged in a service or a product that you understand, because there's no point in buying something, a complete pig in the poke, in terms of whatever they're doing. It's complete speculation then. So knowing the company, knowing what they do, knowing the type of business they're in, knowing the industry they're in is very, very useful. Fifthly, there has been 50 declines in the United States stock market, or in the stock exchange in the United States, the Dow Jones, since over the last 100 years or thereabouts. 50 declines. So on average it declines by 10% every 2 years. There's a fall or a drop. That's a great opportunity. Over the same period of time, there has been, I think it is 15 declines of 25% or more. So 25% or more is considered to be a bear market. There's been 15 of those where the market has declined by 25%. Again, that's a great opportunity to buy shares in companies at good value prices. And finally, don't be too concerned about getting cheap shares or a complete out and out stonewall bargain. You're far better off buying into a good company that's a solid performer over a long period of time, rather than taking a punt on a company that's on its last legs and the shares appear to have fallen through the floor and they look like a bargain. But they might look like a bargain, but it's very like somebody going to buy clothes or shoes or anything else. What appears to be a real bargain falls apart within a matter of months, and what's quality is going to be with you for the long haul and is the best method to adopt, the best strategy to adopt in the long run. So they are the 6 principles. If you stick by these 6 principles, you will do well buying shares, investing in shares, but you're not buying them to trade them, you're not buying them to flip them, you're not buying them to speculate on very short-term price movements. You're buying pieces of good, solid, performing companies, and you are then going about your business, the companies are going about their business, and you will reap the benefit over a period of time through compounding compound interest and the reinvested dividends that you'll receive, and so on and so forth. But hope you find this video useful. As I say, there are 6 sound principles that will serve you well. They are from Peter Lynch and Warren Buffett, and those 2 gentlemen are probably the most successful investors in shares and stock markets and so forth for ever. Anyway, hope you find the video useful. If you do, I'd appreciate if you gave it the thumbs up down below. Thanks a lot.